Welcome to a deep dive into the most critical, yet often overlooked, aspect of trading, psychology. You might have a robust strategy, sophisticated indicators, and years of market experience. Yet, if consistency eludes you, the answer likely lies within your own mind. We are here to explore the groundbreaking work of Mark Douglas, a true pioneer in understanding the mental game of trading. His insights have transformed countless trading careers, shifting the focus from predicting markets to mastering oneself. Douglas fundamentally believed that trading success is 80% psychology and 20% strategy. This isn't just a catchy phrase, it's a profound truth that separates consistently profitable traders from those trapped in cycles of frustration. His influential books, Trading in the Zone and The Disciplined Trader, are considered essential reading. They have impacted legendary traders and continue to guide serious market participants toward mental fortitude. This session is specifically for you, the beginner, intermediate, or even advanced trader. You understand market mechanics but struggle with discipline, emotional control, or achieving consistent results despite your knowledge. Our goal is to break down Douglas's core philosophy into actionable insights. We will explore his 5 fundamental truths and 7 principles of consistency, providing a clear path to psychological mastery. Building a solid trading foundation begins with adopting a probabilistic mindset. This means understanding that trading is not about predicting the future but about managing probabilities over a series of trades. The first fundamental truth is, anything can happen. The market is a complex, dynamic system where unforeseen events constantly occur. Embracing this uncertainty is vital. It prevents overconfidence and fosters the flexibility needed to adapt. You must release the need to be right about any single trade. Accept that even the highest probability setup can fail. This acceptance is the bedrock of emotional resilience in the face of unexpected outcomes. The second truth is, you don't need to know what will happen next to make money. This is perhaps the most liberating concept. Your profitability comes from the statistical edge of your system played out over many trades, not from predicting the next tick. Focusing on prediction leads to anxiety and poor decisions. Instead, concentrate on executing your edge flawlessly, trade after trade. The power is in the process, not the prophecy. Applying this truth involves rigorous backtesting and forward testing. Build unwavering confidence in your system's edge by observing its performance across diverse market conditions over time. The third truth states, wins and losses are randomly distributed. Even with a profitable edge, winning and losing trades will not occur in a predictable sequence. You might have several losses in a row, followed by a string of winners. Emotional reactions to streaks, whether fear during losses or euphoria during wins, are detrimental. Understand that each trade is independent within the larger probabilistic framework of your system. This understanding helps you avoid getting caught up in the outcome of any single trade. You see each result as merely one more data point in the long run of your strategy. The fourth truth is, an edge is just a higher probability of one outcome over another. Your edge is a repeatable process or set of conditions that gives you a statistical advantage over a large number of trades. It doesn't guarantee any single outcome. This edge must be clearly defined and quantifiable. You need to know your system's win rate, average risk, reward, and other relevant statistics based on historical data. Continuously refine your edge through data analysis and journaling. Focus on executing your edge consistently, knowing that the probabilities will work in your favor over time. The fifth truth is, every moment in the market is unique. While patterns repeat, the underlying conditions, participants, and context are always slightly different. You cannot simply project past outcomes onto the current moment. Treat each trade setup fresh, free from the emotional baggage of previous wins or losses. Avoid biases formed by recent market behavior or personal trading history. This requires being fully present and objective when evaluating a potential trade. Your decision should be based solely on whether your defined edge conditions are met in the current moment. Moving from understanding to action requires implementing principles that build consistent behavior. These principles translate the probabilistic mindset into practical trading habits. Principle 1 is, know your edge. This goes beyond a vague idea of your strategy. You must have a clearly defined, backtested system with specific entry, exit, and stop-loss rules. Quantify your edge based on historical data. Understand your expected win rate, average profit per winner, average loss per loser, and maximum historical drawdown. This data builds rational confidence. Utilize tools like TradingView or other charting platforms to analyze historical price action and test your strategy rules rigorously. Data is your ally in building conviction. Principle 2 is, define your risk before trading. Never enter a trade without knowing exactly how much you are willing to lose if it goes against you. This is non-negotiable. Predefining risk with a hard stop loss eliminates emotional decision-making during the trade. You accept the potential loss before the trade is even active. Apply this principle by calculating your position size based on a fixed percentage of your trading capital, such as 1 or 2% per trade. This ensures no single loss can cripple your account. Principle 3 is, accept risk completely. Once you have defined your risk, you must mentally accept the possibility of losing that amount. This acceptance is crucial for trading without fear or hesitation. Being at peace with the potential outcome, whatever it may be, frees your mind to execute your plan objectively. Fear of loss is a primary driver of trading errors. Practice visualization techniques to mentally rehearse accepting losses. Imagine placing the trade, hitting your stop loss, and feeling calm and accepting, ready for the next opportunity. Principle 4 is, act without hesitation. When your edge conditions are met, you must execute your trade without delay. Hesitation often stems from the fear of being wrong or the fear of loss. Your decision to enter is based on the confidence in your edge over many trades, not the guaranteed outcome of this single trade. Trust your system and your preparation. Overcome the fear of being wrong by remembering that being wrong on a single trade is irrelevant to your long-term profitability. What matters is consistently executing your edge. Principle 5 is, take available profits according to your rules. Just as you define your risk, you must define your exit strategy for winning trades before you enter. Avoid the trap of greed. Stick to your predefined exit rules, whether they are based on a target price, a trailing stop, or a time limit. Don't let a winning trade turn into a loser because you hoped for more. Using tools like trailing stops can help capture more profit in strong moves while still adhering to a systematic exit strategy. The key is having a plan and following it. Principle 6 is, monitor your emotions constantly. Develop a high level of self-awareness regarding your emotional state before, during, and after trading. Recognize fear, greed, overconfidence, and frustration. These emotions are signals that you might be deviating from your plan or reacting to outcomes rather than executing your process. Emotional control is an ongoing practice. Use a trading journal religiously. Document not just your trades but also your mental and emotional state at the time of decision-making. Identify patterns in your emotional responses and their impact on your trading. Principle 7 is, follow your rules without expectation. This principle encapsulates the core of disciplined trading. Be rigid in your adherence to your trading rules, but flexible in your expectations about the outcome of any single trade. Your job is to execute your edge flawlessly, trade after trade. The market's job is to produce the outcome. You control your behavior, you do not control the market's results. Using a pre-trade checklist can help ensure you follow your rules consistently. Tick off each condition before entering a trade, reinforcing your commitment to your process. Even with a solid understanding of the truths and principles, psychological barriers will arise. Recognizing and addressing them is crucial for sustained success. One major barrier is the fear of being wrong. This often stems from ego and the need to be right. In trading, being wrong is simply part of the probabilistic game. It's not a reflection of your intelligence or worth. Let go of the need for external validation or the feeling of failure when a trade loses. Focus on whether you followed your process, not whether the trade was a winner. The fear of loss is another significant hurdle. This is directly addressed by Principle 3, accept risk completely. By predefining and accepting your risk, you neutralize the power of this fear. Understand that losses are simply the cost of doing business in trading. They are necessary occurrences within any profitable system. Embrace them as part of the process. Greed and overconfidence often emerge after a string of winning trades. Greed pushes you to take on too much risk or hold winners too long, while overconfidence leads to deviating from your rules. Stick rigidly to your rules-based framework, especially after wins. Remember that past performance, whether good or bad, does not guarantee future results. Maintain humility and discipline. For advanced traders, integrating mindfulness techniques can significantly enhance emotional regulation. Practicing mindfulness helps you observe your thoughts and feelings without judgment, creating space between stimulus and reaction. Develop a consistent pre-trading routine. This routine should prepare you mentally and emotionally for the trading day, helping you enter the market in an optimal state of mind, free from distractions and emotional baggage. We have covered Mark Douglas's transformative framework for trading psychology. We explored the 5 fundamental truths that form the basis of a probabilistic mindset and the 7 principles that guide consistent, disciplined execution. Mastering trading psychology is not a one-time event, it is an ongoing practice of self-awareness, discipline, and commitment to your process. It requires conscious effort to reprogram your thinking and behavior. To truly internalize these concepts, I strongly encourage you to read Mark Douglas's books, Trading in the Zone and The Disciplined Trader. They offer deeper insights and exercises. Start or continue keeping a detailed trading journal, focusing on your psychological state during trades. This is your most powerful tool for self-discovery and improvement. Finally, rewatch this video. Reinforce these truths and principles until they become second nature. Your journey to consistent profitability depends on mastering the market within you. Give it a like, follow or comment below if Mark's principles help your trading.